Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Tuesday, May 10th, 2022. Hope your week is off to a good start. Markets continue to be under pressure here. We're back with an update to talk to you about some of the important price levels that we're watching, as well as the major news flow this week, some economic data that we expect to get tomorrow morning that could have a big impact on which way the market goes next. So let's start with the S&P 500. As like a magnet, we spoke about last week, our expectation that the market would pull into the 3950 to 4000 level, represented by the shaded box on the screen here, and we got exactly that. The move did take place a lot quicker than we anticipated. On the back of the Federal Reserve meeting last Wednesday, we had a big rally followed by a big sell-off where investors appeared to be very unsure if the Fed has enough credibility to get their arms around inflation and some of the other problems we're dealing with economically. So what we saw was the market pulled right into that 4,000 level. Let's zoom in a little bit. We could see a little more closely. The market pulled right into that level, pierced into that level, and bounced outside of it. So it is very important that we're going to watch this level because we expect there to be some support for the market at these levels, not just because that it's a big round number like S&P 4000, but this is a previous demand zone, areas when the market had hit this level going back a year and a half. There was a lot of demand, a lot of buyers in this level, and we think it represents a good place for investors to step back into the market after a 20% plus decline on the major indexes. But nonetheless, we are now at this level. It's a critical juncture for the market, and a lot of folks, including ourselves, are watching to see what the market does on this level. We did pierce into this level yesterday and started there lower this morning before bouncing out of it, which is why we see some of these smaller candles here where the market came down into that level about 39.60, right? So we talked about 39.50 to 4,000. Market went 39.60 and got a little bit of a bounce. Markets are now higher on the day, still about 20 minutes before the close here on Tuesday. So remains to be seen where the market will go from here. But we are looking for some relief at these levels. We have a major economic data point coming out tomorrow morning that we think will determine the future direction of this market, at least in the short term. And that will be tomorrow, Wednesday, May 11th, 8:30 a.m. We get the release on the Consumer Price Index. Now, the Consumer Price Index is the Fed's favorite gauge on inflation. It's something they watch very, very closely. And as we know, CPI has been rising month over month over month for the last year plus. So everybody is looking for that inflection point where inflation is going to start to roll over. We think we may be there. We'll see tomorrow. Again, we don't want to put the cart before the horse, but I think some of the data points that we've looked at outside of the core CPI suggest that inflation is starting to moderate and may very well be peaking. And I'm going to explain to you in a minute how this whole thing fits together with inflation, interest rates, narrative, and the stock market, of course. So 8:30 tomorrow morning, we'll see the Consumer Price Index, we'll see core CPI, and we'll importantly get that year-over-year number. Anecdotally, used car prices are falling very quickly, collapsing actually, after a meteoric rise. Now, this is a leading indicator for inflation, something we watch very closely. I shared a different graph last week when we talked about the Manheim Used Car Value Index, but we're starting to see used car prices collapse, and we don't think it's because of a lack of demand. We think it's more so a byproduct of that inflationary trends may have run their course, at least in the short term. Now, what we want to see not only is inflation top out, we want to see it start to come back down. Because if it just tops and stays at a high level, that's called stagflation, where inflation remains entrenched at very high levels, and it could start to hurt economic growth. We're not calling for stagflation. We don't believe that'll be the case here. We think a lot of deflationary forces exist in the world today, and a lot of the COVID stuff, supply chain issues, will start to work themselves out. So we'll get a good readout on that tomorrow. For a moment here, I want to talk about the narrative, how it affects interest rate, affects the Fed, affects short-term rates, affects stocks. And let me just bring up a very elementary example I made here, but I wanted to share this with you folks. So give me a second here. Let me make sure this is centered on the screen. Okay, so what you have here is essentially cycles, and I want to make this a little bit bigger, okay? We have the current cycle that we're in right now, and we have the expected cycle that we think we're going to. So let me just break this down in a very elementary fashion for you. I know a lot of you folks follow along with this, but some of you have asked me questions about it, and I think it's very important. So what you essentially have is a period of time where the economy is in an expansionary mode, very quick expansion. And what happens during that period of time is inflation rises. Let me just click off this so we can see. So inflation will rise. When inflation rises, short-term interest rates rise, right, through the 10-year Treasury yield. When the 10-year Treasury yield starts to rise, the Federal Reserve is forced to act to lift the federal funds rate, right? That's the interest rates that they control. Now, why are they forced to act? Well, because if the 10-year interest rates are rising, the Fed really has no choice but to keep up with those rates. When it happens too quickly, stocks begin to fall. When stocks begin to fall, investors become bearish, right? And it's like a death cycle that just keeps spinning over and over and over. What we are anticipating, the reason we continue to remain invested, and the playbook that we are using, because we have seen this happen before, is we anticipate there will be a seismic shift in this cycle, and we're going to start to go the other direction. And what that would look like is inflation will start to fall, whether it's tomorrow, next month, or 2 months from now. At some point, inflation will start to fall. With that, the 10-year Treasury yield will start to fall as well, right? Because it'll realize that inflation is not becoming entrenched, and therefore the economy does not warrant higher rates to cool inflation. When interest rates start to fall, it will give the Federal Reserve more room, more flexibility, a little bit more operating flexibility, I guess, for lack of a better word, where they don't need to be as aggressive, and therefore they will not need to continue to raise rates. If the Federal Reserve backs off or even signals that they're going to pivot on monetary policy, stocks will rise and investors will come bullish and the cycle will repeat itself. Now, we lived in that cycle for a number of years, and a few points along the way, interest rates started to rise, inflation started to show itself, and the Fed started to do what they've been doing over the last couple months. So we are very familiar with this cycle. We are currently in this top cycle, but I want you to know we do not think that this lasts forever. We know that it won't, because we know that economies go through cycles, and right now every investor is just trying to figure out at what point will the Fed pivot. So we think tomorrow will give us a good read on where CPI is going, therefore where inflation is going, and at what point the cycles will shift from the vicious cycle we're stuck in right now to something that's a lot more friendly to investors. Another thing we want to point out, I know this chart's a little bit small, but investing is all about valuations, folks, right? What are you buying? What are you paying for it? And what is the future value that you would like to or think you could assign to that asset? And we use valuations to guide our buying in terms of, are we buying things that are expensive or are we buying things that are relatively cheap? And when we look at the graphs on the screen here, looking at the S&P 400 and the S&P 600, which, as an aside there, a lot of investors only hear about the S&P 500, but there is a 400 and a 600 as well. And we are seeing that a lot of stocks in these market indexes are trading at extreme discounts. A lot of them, folks, are trading at the same valuations that we saw during the COVID crash of 2020. And what we're trying to convey to investors is, folks, in March of 2020, this was a far different environment. We were staring in the face of a once in every 100 years pandemic, and nobody knew what the next month, 3 months, 6 months, and year was going to look like. That was a far different time for stocks. Naturally, there was a lot of questions, there was a lot of concern, and nobody knew how markets would respond, because we hadn't seen anything like this really since, the 1918 flu, and obviously none of us were around for that. So we have to lean on valuations in time like these, and the fact that the economy remains strong and the consumer remains strong suggests that stocks have become too cheap, too quick, and this is something that investors should be looking to take advantage of. Nobody knows exactly what day the market will bottom. It could be today, it could have been yesterday, it could be a month from now, but it's making measured buys and measured investments when you're investing in things that have good valuations, that can grow over time, that those types of investors will be rewarded. Another thing, folks, that I want to mention, right? We talk about the Fed needing to pivot. I know a couple people have pushed back on that notion to me and said, but Mike, the Fed's only hiked rates 2 times, right? How could they possibly pivot off of this path of monetary policy this soon? Here is example A right here, okay? Even though the Fed has only moved to raise interest rates 2 times, a lot of tightening has been done already in this economy, folks, because the 10-year interest rate has risen, and with that, all the different lending vehicles and funding facilities in the country have raised rates as well. This is the 30-year mortgage. Look at the move in 30-year mortgage rates just in 2022 alone, folks. We're talking about coming into the year at a 2.9% annualized rate on a 30-year mortgage, and it's currently over 5. And this chart was from a couple days ago. It's probably higher now. So, again, a lot of tightening has been done in the economy. A lot of bad news has been priced in, and we see a Fed that we've watched for many years. Even though the participants change, the game doesn't change, folks. They will hit a point where they realize we have done enough tightening, we have done enough restricting of the U.S. economy, and we need to pump the brakes on all this tightening before we send the economy into recession. And the last thing we want to point out to you is when we look at some of our trend analyzers here, right, and we look at the different, these are all the U.S. market sectors, okay, representative of all the different areas of the market. Everything right now is extremely oversold. Extreme OS means extreme oversold. So whether you think the market is in a bull market, bear market, or flat market, nonetheless, this points to the fact that we should expect a bounce here in the short term. A lot of assets have come under pressure the last couple of days. It certainly looks like capitulation to us, you know, that climactic moment where investors throw in the towel and say, get me out at any price. And it's times like this we have to remember what we own and why we own it, because good quality companies will recover the fastest on the other side of this downturn. So again, we know right now we're in the middle of a storm, but behind the clouds of every storm, the sun is shining somewhere. The sun will shine on this market again. And yes, the market environment right now is such that companies can't seem to do anything right. You know, you report good earnings, your stock goes down. You report bad earnings, your stock goes down. You report flat earnings, your stock goes down. And folks, that's just indicative of a nervous market, right? We see rallies. The rallies don't last because investors are selling into every rally. That too will shift, right? I've said it 100 times. The pendulum and everything in life swings both to both extremes in both directions. We believe that to be the case with the market. And we will once again see a market environment that companies are rewarded for good, solid earnings and fundamentals. So hang in there. We'll continue to bring you the information as we see it. We'll be watching very closely for that consumer price index report tomorrow morning to see if we can get some confirmation that inflation is starting to peak out. If you have any questions, please reach out to us. Always here to talk to you about anything that's on your mind. We'll see you back later this week for the Heritage Market Pulse.